Thanks everybody again for joining us today for another SCF webinar. Excited to discuss how we're structuring bankable C&I projects as we move forwards. Today's agenda is as follows. We'll touch briefly on who we are, Sustainable Capital Finance. We'll discuss the evolving landscape of C&I solar and storage and provide market level insight regarding how different factors are determining whether a project is economically viable or not. We'll then go into why SCF sees value in incorporating EV charging and provide additional insight regarding the types of sites we're targeting and showcase an example project. We'll finish up with a few notes on our process and answer any questions that you may have. So for those who are unfamiliar, Sustainable Capital Finance, or SCF, is a third-party financier operating primarily in the commercial and industrial space and providing energy as a service. SCF operates very similarly to a developer as we work directly with solar integrators, property owners / businesses, schools, municipalities, and nonprofits to bring projects from concept to completion. We can step in at any time in the development cycle and have strong financial backing to ensure the projects are executed at a high level. And that is shown by the fact that we have over $500 million in counting in contracted distributed generation. Let's kick off by looking at where the C&I solar and storage market stands today. Since the passing of recent legislation, we're firmly in the post-BBB era, or One Big Beautiful Bill Act era. Investors are no longer just betting on capacity and output. They're drilling into policy alignment, supply chain resilience, and most importantly, long-term predictability, which will be a key component of something we'll talk about here later. One major change: the domestic content rules. Projects now have to demonstrate U.S.-based sourcing of steel, iron, and manufactured products, which obviously adds complexity, but also differentiator for bankability. For developers, that means project structuring needs to reflect not just performance, but compliance readiness and supply chain traceability. And importantly, what we call value stacking. Combining solar plus storage plus emerging loads like EV charging is becoming a core requirement. And as we'll talk about here later, something that we find to be a huge value add as well, in addition to that. Because really the question now is not just can we build it, but can we build it in a way that meets investor criteria, policy criteria, and delivers multiple revenue streams. So the takeaway: bankability isn't only about kilowatt hours anymore. It's more about how your project aligns with policy, supply chain, and market risk frameworks. Next, let's drill into incentives. The federal investment tax credit, while it remains here for the next few years, remains foundational. And what really remains foundational is the importance of capturing all the adders. Domestic content, energy community, low income, anything that we can incorporate the additional 10% ITC adder to that base 30% ITC will be a way for us to be able to structure projects and provide more competitive PPA pricing to the customer. Now, as we're going to see here starting after mid-2025 and into late 2027, the domestic content thresholds for PV are going to increase. And so that's going to make the domestic content requirements and meeting those trickier and something that we'll have to work through together from a developer and EPC standpoint. Now, on the state and utility side, many markets offer layered value: rebates, performance-based incentives, demand response participation, on-bill financing, etc. And what this means really is that the strongest projects are integrating incentive capture from day one, modeling incentive eligibility, potential tariff impacts, interconnection timing where there might be delays, and device eligibility in the early feasibility phase, and not looking at it as an afterthought. In short, it's no longer what's the incentive, but how do we capture every eligible incentive, layer them properly, and make sure the supply chain and siting align. Now let's talk about geography and tariffs, two factors that often make or break the economics of C&I solar plus storage projects. Now first, tariff structure. Especially demand charges remains one of the biggest swing variables. A project might have excellent solar production, but if demand charges aren't well handled or the storage system isn't sized correctly, the savings get eroded. So for developers and property owners, modeling load profiles, interconnection metrics, and demand charge mitigation is critical. Designing the system for an economic use case scenario where we're prioritizing savings for the customer is the most critical component for us to provide the most competitive pricing for that customer. Now, secondly, geography matters. Now, that's not just because of sunlight or wind, but because it drives which incentives, tariffs, and supply chain realities we face. Some markets already offer strong bonuses and predictable frameworks, thinking of some parts of California, New York, Illinois. Other states in the Midwest or Southeast may have fewer adders today, but may offer better scalability or less complexity. From an investor's lens, the focus is on predictability, scalability, and transparency. Portfolios of projects that are well understood, repeatable, low surprise, and can scale across markets rather than being one-off. So when you bring all these components together, we need projects that are aligned with policy and incentives, structured around site-specific tariff and geography risks, and positioned for scale. Now that sets the stage for the next part of our discussion, how integrating EV charging can amplify value in that framework. So as we just discussed, geography and tariffs shape where projects make sense, and EV charging is quickly becoming one of the strongest ways to add value across all those markets. EV adoption is surging. More than 4 million EVs are now on U.S. roads, but public charging infrastructure hasn't caught up. That gap creates a real opportunity for property owners to step in and benefit. Through SCF's program, site hosts can install EV charging stations with no upfront cost. SCF handles all equipment, installation, and maintenance, while the site hosts earn a revenue share from each charging session and gain a valuable new property amenity. It's an easy way to attract new tenants or visitors, increase property value, and align with investor demand for clean, infrastructure-backed assets, all supported by SCF and our financially strong partners. In short, EV charging isn't just an add-on anymore. It's the next phase of value creation in the C&I MG landscape. When it comes to EV charging, location really determines success. The best sites tend to check a few key boxes. First, they're in areas with strong EV adoption or growth potential, regions where drivers are already looking for reliable places to charge. Second, they have consistent on-site activity, whether it's shoppers, hotel guests, employees, or gym members, anyone who naturally spends 30 minutes to a few hours on site, which is a perfect fit for a level 3 fast charger. Now, proximity to major routes is another major factor. Sites near freeways or interstates capture transient traffic and become natural charging stops. And from a practical standpoint, available space and adequate electrical capacity make installation smoother and more cost-effective. Now, we've seen the strongest performance from property types like shopping centers, grocery stores, restaurants, gyms, car dealerships, all locations where time and convenience align perfectly with what they're looking to do on site. In short, a great EV charging site is one that's already part of a driver's routine. We simply help the property capture that traffic and turn it into long-term value. Now, we'd love to look at a single site example for you all. The next 2 slides will cover this. For this project example, it would be a 500 kilowatt project. So this might fit a grocery store, a gym. In some cases, we've seen churches where they have maybe a restaurant or a coffee shop associated where That's kind of part of the main meter. Where a 500 kilowatt project with 8 chargers might make sense, right? Because from a space perspective, that's would be kind of the biggest question that one could have immediately here. Is kind of where are we putting a 660 kilowatt hour battery, 8 chargers, and 500 kilowatt of solar, and expecting decent traffic. And like I said, I think a grocery store, gym, larger church, or religious facility in some capacity all kind of fit the mold here. And this can be 4 dual ports, right? Or this could be 8 180, 200 kW fast chargers. Now with this, we have a $3 solar watt, or $3 per watt solar cost assumption. So we're assuming most likely a rooftop build here. And we're able to get ESS and EVC cost assumptions pretty cost effective via the relationships that we currently have when we're developing these projects. So onto the example terms. So this would be an 8 charger project. Like we mentioned, 500 kilowatts of PV, 660 kilowatt hours of battery storage. And in year 1, the customer would see with revenue share of roughly $61,000 and PPA savings at around $12,000, and an increased net operating income of roughly $73,500 in year 1. Now, for us, we generally utilize some form of EV utilization escalator, and for us, that's generally 3%. And we do that after the first year 1 to year 2 jump, which is where, generally speaking, historically, you'll see the biggest jump for any EV charging stations from year 1 to year 2. We'll see the same thing for the price of the EVs to use them. And then for us, from the PPA savings standpoint, we're utilizing basic generic inputs, 4% utility inflation, and then a 2% escalation for the PPA rate itself. So forecast that over 30 years, and the customer will see $6.5 million in expected revenue share from the 8 chargers and around $2.7 million from savings from the PPA over that same time period. Now, we don't showcase the more grandeur offer in forms of the revenue share and compared to the PPA savings for no reason. Our goal here is to showcase we find the value currently for a lot of these projects from the customer's perspective in the form of the EV charging stations and the revenue share associated, right? As costs are increasing across the board from an equipment standpoint, from a timeline perspective, from operating cost perspective, right now it's hard to lock in cheap pricing for anything. And so I think for us, we expect that to be the case for PPAs moving forwards. They're just not going to be as competitive as they were prior. And the way that we find value for the customer in lieu of that is not to remove it entirely, right? We still want to make sure it's a component of all of our projects, whether that's through a PPA or through an ESA, but where the customer can really see upside, really see a large portion of economics be a driver for them, is through the revenue share from the charging stations. And so this is a standard 500 kilowatt grocery store, gymnasium, what have you, with 8 chargers, where they're seeing over 30 years roughly $6.5 million in revenue share, in addition to PPA savings nearing $3 million. And now they have close to $10 million in additional income that they wouldn't have had otherwise, right? And so not only does the combination of the charging stations plus the PPA make it more valuable from the investor perspective, but from the customer's perspective, they're seeing way more upside than they ever would currently with a standard, just standalone PPA on their projects. So what's next? What's SCF's process? How do you get involved? How do you get pricing on a project? Here is everything kind of laid out for you. Would love to get you registered on the SCF suite. Whether you're installing projects, you're developing projects, it can be a great resource for you to get indicative pricing, generate proposals, upload documents, and ultimately learn how to utilize the suite as a resource for you as much as possible, as early as possible. I think would be a great place to start. From there, we can look at a project together. If you have a copy of an energy toolbase report or the utility data, generally we'll ask for the interval data or bills. Last 12 months would be ideal. In addition to a copy of a site design, so whether that's a helioscope or a PV-sys, and the estimate all-in build costs would be the necessary components that we would ask for to run an initial pricing on a project. From there, hopefully we can have pricing back to you in a few days, sign a term sheet with the customer if all goes well, have a kickoff call with that customer and with you guys, whoever's bringing that project to us, and then kick off the diligence period, which can take 1 to 3 weeks depending on what diligence has already been completed, and work through that process with the EPC and with the customer to hopefully have agreements executed in 30 days. And that's all we have today, webinar-wise. I'm going to pass it back over to my colleague, Clifford Chang, and he's going to be able to answer your questions to the best of his ability. Thanks for your time.
Thank you, Matt. Thank you for a very informative presentation. We do have some time left for questions. If you have a question, please type it into the chat box located at the upper right-hand corner of your screen. It is a text box with a question mark in the center. A few questions have come in already. The first question is, what are the PPA and charging prices we considered in the model that we showed? That was a sample project of a grocery store, as Matt mentioned. I believe it was in Southern California. I don't recall the exact PPA price, but we would take into consideration the utility rate, interval data, rate plan to calculate an avoided cost for the project. At that point, we would offer some discount between 10 and 20% off of that avoided cost, depending on the project economics. The public charging rate contemplated in California, I believe, was 61 cents in this example, but we will be setting the charging rate at whatever the prevailing market rate is for the state and for that particular area. And I will say that DC fast chargers typically garner a higher public charging rate than slower level 2 chargers. Hopefully that answers your question. Next question is, have you done PPA projects in Georgia? I know that our scope is nationwide. I believe Georgia is a state which does not allow third-party system ownership. I could be wrong, but that could be one of the restrictions for not having done a project previously. I know that there are new incentives for EV charging in the state of Georgia, and I would just encourage you to contact us, and we can get into more detail on a project-by-project basis. Thank you for that question. What was the deployment cost in the example? That slide is no longer up, unfortunately. We try to use indicative pricing at the beginning. I believe we allowed $3 a watt for the solar installation. That price obviously will vary depending on the type of installation, be it rooftop or carport. prevailing wage is a factor in certain states and on certain projects in order to garner the maximum tax benefits. But that is a rule of thumb. Typically, once we have established a proposal and the customer or property owner wishes to proceed, we would obtain final EPC pricing via a bid process. Next question is multifamily projects. Those would be assessed on a case-by-case basis for charging, whether there is proximity to a highway, enough public access. From a solar standpoint and storage standpoint, we would certainly take a look at those projects. If they are master metered, there is greater benefit. If the buildings are individually metered, it could be tougher, and that would depend on the amount of common area demand that we could offset. Hopefully that answers that question. Next question is, how do we create 61,000 in EV revenue? I have a Tesla. Seldom do I see all of the chargers being used. We use a very conservative utilization rate that varies from site to site. We would analyze each property for a number of factors: zip code, median income, proximity to the highway, number of EVs in the area, etc. Those are used to come up with a utilization assumption. Typically, those are conservative assumptions, and that basis is used to calculate the revenue projection. Quite a few questions. Next question is, how does the revenue sharing work on the chargers? Wherever possible, we try to offer 10% revenue share. That is on the gross income minus network fees, processing fees for credit cards, and the like. It is not a profit share, which would further discount for cost of electricity, operations and maintenance, insurance, etc. So that revenue share is much higher. In comparison, most public charging companies offer a per site, per parking spot site rental. Typically, that's about $200. So if you looked at our example of 8 charging stations and assumed you were getting $200 a spot, that would be roughly $20,000 a year. So our revenue share is much higher. Also, those charging companies typically do not offer any form of escalation year after year. So those are flat rate rental payments. Our program provides the benefit of upside to the property owner. So if the utilization increases, the revenue share also increases. Hopefully that answers that question. Next question is, somebody had a mishap with their feed. A recording of this will be available. I believe a follow-up email will be sent and instructions on how to watch the presentation again are available. That is, I think we have one last question. let's see, actually quite a few questions just came in. Let's see. Would we currently serve Puerto Rico? I think we would assess that on a case-by-case basis. I encourage you to contact Matt or myself after the webinar, and we can discuss that further. Next question, does the PPA model need customer contribution, or are 100% of project costs financed? So this is not financing per se. This would be a third-party investor-owned model. There would be no capital expenditure or capital requirement by the customer, just an agreement to purchase the power generated by the system. Next question is there a minimum EV charging project size, and how does financing stack with utility incentives? Typically, we look for a site where we can install a minimum of 100 to 200 kilowatts of solar, depending on the host demand. And 4 chargers is usually the minimum number we like to install at a site. And those calculations or analysis would be governed by those factors I mentioned before. Traffic count, proximity to the highway, etc. But generally speaking, 4 chargers, 200 kilowatts of solar. The storage doesn't have a minimum per se, but would be sized based on the electricity demand at the site. Next question, what is the process for getting onboarded here? If you reach out, I believe our information was at the end of the presentation, but my email is ccheng, C-C-H-E-N-G, at scf.com or mbrown@scf.com. If you send us an email, we can set up a suite demo, send you the relevant materials. There will be an email with a sign-up link sent out to all of the attendees. So if you access that link, we will get you onboarded and access to the suite. Let's see, I think that is all of the questions that were submitted. I thank you very much for your time and attention today. Please look out for the follow-up email with additional information on accessing the recording, getting in contact with us. We look forward to any future collaborations with all of you. Again, thank you very much and look forward to being in contact in the future. At this point, we will end the webinar. Thanks again for your kind attention and participation today.